Welcome back to another Meet Kevin report. Look, Oracle just reported earnings, and once again, we've been talking about this for many months. The software artificial intelligence companies are disappointing. I really think this is the way forward. That software artificial intelligence companies disappoint. That's mostly because remember what started the AI revolution? What started the AI revolution was NVIDIA. NVIDIA following GPT, right? We had GPT. It's like, look, oh my gosh, we have this incredible chatbot. What now? We have services like Midjourney that you can plug into Discord and have beautiful images as well. And we need a lot of GPUs to process this sort of data and information and content creation. And so we get a couple great pieces of software that turn into everyone in the world wanting to create another great piece of software, many of which just built on the backs of OpenAI, and then obviously subsequently NVIDIA and otherwise. And all of a sudden, there's this thought that all of the legacy companies, the Snowflakes of the world, the DocuSigns, the CrowdStrikes, the Cloudflare, that all of a sudden, all of them are going to become fantastic AI companies overnight. And so far, that appears just not to be the case, especially after you read the earnings calls at Snowflake, where you get a really good heads up that maybe the CEOs themselves aren't even that confident. But not only is it the CEOs that aren't even that confident about their ability to actually generate profits from artificial intelligence, but it might not even be sort of the tech bros that are generating the biggest revenues for software. It might end up being healthcare, which then the question is, okay, well, is it the healthcare companies themselves that are going to make most of the money, or is it these other companies that are going to make money from AI? That's the big question right now, is who's actually going to make money from AI, and who it's not apparently is Oracle, with apparently now suggesting that their results, the street now suggesting that the results of the Oracle earnings are raising questions about the timing of generative AI demand turning into revenue across the broader business cycle. And quite frankly, I look at this and I'm like, duh. Like, the whole AI stuff started about 6 months ago. This is really when things, maybe February, so it was 6 to 7 months ago. How do you expect these massive software companies to turn around and start? All right, that's it. We know exactly how to make money with this. They don't. Snowflake literally said it best in their last earnings call. Snowflake and their CEO literally made the argument that everybody's kind of just been thrown into this foray and nobody's figured out how to make actual money from it yet, except for Nvidia and obviously, therefore, subsequently, the chip manufacturer. So, my opinion is, again, if you're looking at those software artificial intelligence companies, probably just something to keep in mind that it might end up taking a little bit more patience. Now, one thing that, when it comes to software, software companies that people do like in the artificial intelligence play has to do with advertising and data centers, and specifically Trade Desk, Facebook, Meta, and Google potentially still being, and AWS as well as Microsoft potentially still being up there in terms of opportunities to invest in AI, where you're kind of at that next layer where you've kind of got, right, if there's open AI and then there's all the chip stack underneath it, all that has to run on servers. So how about the server providers, which Oracle is as well, right? And no surprise, these server revenues, those do well. But the question is, what about all the apps that run on them? Are those actually going to make money? And a lot of that is in much more doubt now than people had hoped. But anywho, I mean, you look at sort of the hopium that went into some of these plays as well. I mean, here's Oracle. Look at the hopium. It went from like $59 in November straight up to $126. I mean, okay, big deal. You're down 8% now in pre-market, but you're just back to this support level where you've been bobbing around before. So maybe it's actually not that crazy from a stock point of view. I know when people hear, oh my gosh, stock's down 8% or whatever, even 10% in the day, it's a big deal, but stock's done very well here. So maybe this isn't that big of a deal from a stock price point of view, but in terms of this happening again, just wouldn't surprise me to see it happen again. These these services are going to be, I think, a lot harder to sell than people think. Mostly because every company's like, oh yeah, we'll turn on the AI button, and they're like, all right, what are we actually going to do? Nobody quite knows yet, which is very similar to what we were talking about last week and many months before that. But anyway, let's jump on over here. Let's listen to what's going on here.
I'm fighting that too. Fossil fuel administration. It's happening in spite of the Biden administration, not because of it.
Well, hold on. No, it's not. Because first of all, that IRA bill says you are not going to go out and put windmills in the Gulf or solar farms and windmills on BLM land unless we're extracting the minerals. They're trying to do everything they can to get around that. That's my problems I have. Implementation. They're trying to implement a piece of legislation they never passed. Just implement the bill that we put in front of you. Also, what you've never heard, $238 billion of that bill that was about $690 billion as far as how it scored, 238 of that went to debt reduction. You never heard a word about that, Joe. No one's talking about it. Was a balanced piece of legislation. The administration is liberalizing it to the point, and we're fighting it. We got the Mountain Valley Pipeline that we're going to put 2 billion cubic feet of gas into the market. Okay, we're producing more than we ever have because they had to force them to do some leases they didn't want to do. Then they come back and do the thing in Alaska, which I thought was horrendous. You can't take anything off the market when you have a global demand and you have Putin weaponizing energy. You can't do it. But we can do it better than anywhere in the world. You cannot eliminate your way to a cleaner environment. You can innovate your way, Joe. You cannot eliminate your way.
Senator, are you going to be the West Virginia senator next? What are your plans? Are you going to retire? You have a really tough schedule at West Virginia, the Mountaineers. Could you do anything with? Penn State, that was bad. Are you going to be president of your alma mater? What's going to happen? You going to run for president?
I haven't made any decisions on my political career, but let's go down the list of things you mentioned. First of all, I'm a proud alumni of West Virginia University, a Mountaineer. I'm a very proud person from that institution, gave me a good education. With that, I'm going to support President Gordon Gee and his entire staff to be everything they can be and everything I can do to help them. Okay, so let's leave that there. Next of all, Joe, only in America does the next election start the day after the last election. I don't have anything as far as my filing date in West Virginia doesn't start till January, so I have plenty of time. I got a lot of gas in the tank still left. As you can tell, I'm ready to go. And I believe that the middle needs a voice. There's no voice in the middle. You're either extreme left or extreme right. That's not how we built this country. This is about the United States of America and not let it be divided. And that's what they're trying to do. I don't want you to pick a side. There's only one side, the American side. But there has to be a voice, common sense. Get our financial house in order. And I said this before. My grandfather, as a young boy, used to tell me in a grocery store when I worked with him, I'd say, hey, Papa, what's going on with all this and the money? He said, Joe, let me tell you something. Unmanaged debt will lead you to make cowardly decisions. And that's what's going to happen. The old adage of robbing Peter to pay Paul, that's where that comes from. You just basically shuffle things around. We can't shuffle any longer. We can't carry $600 billion of interest that we're basically paying $600 billion. Next year, Joe, we could be spending more than we are for defense.
If you did become president, Senator, would you cut spending? Would you raise taxes? Would you try to, pro-growth policies? People say the only way out of this, and you mentioned, debt to GDP is going to be.
Everybody's looking for a candidate other than Joe Biden. Now it's Joe Manchin.
World War II now. Well, how would you fix that?
I'm still a fan of Bo Simpson. I was when I first got here in the Senate. I saw a pathway forward. I supported that. I thought we should have supported it. It was a shame, never got a vote. It was a shame. And no one's taking it serious. We need a bipartisan, bicameral group of fiscal hawks, if you will, that can basically come in a bipartisan way to agreement of what we should do long term. There's so many things that can be done, but basically looking at all of the difficult things in my state, Social Security and Medicare is sacred to so many people. We have to protect that. But where we're going right now, we're just sticking our head in the sand and saying, well, in another 8 or 10 years, there's going to be a cut of 20% if we don't fix the fiscal stability of this. So there's things that need to be done. The cap at 167 right now, I'll use that. The cap of 167,000 of salary. Okay, mostly every West Virginian pays that. So 100% of the working people pay that tax.
Right.
But why don't we take the cap off or raise it up some to help the financial stability
Senator,
of it?
if
That
you
won't hurt
don't
anybody.
run, it likely looks like a race between President Joe Biden and former President Donald Trump. What kind of choice? How do you feel about that choice? How should Americans feel about that choice between those?
Well,
two
I know both. I've known President Biden for quite some time. I think he's a very good man, and there's some things that Donald Trump did that I like very much. It's the process of basically villainizing the other side. You know, I don't have a Republican that I think is my enemy. I have Republicans that I might disagree with, but I can sit down with every one of them. I have Democrats that feel the same. I am not a threat. As soon as I announce any of my intentions and my political future, I become basically a real target. Right now, I'm a suspected target. I'm still able to work across the aisle very well and get things accomplished. And there's a lot needs to be done, Joe.
Wow, you're definitely leaving some. That door's not just ajar.
There's a lot of room. There's a lot of
doors, like double doors. I think are open, Senator. Thank you.
Like an automatic garage, like an automatic garage door, right, Joe?
Yep. Thanks for putting up. I mean, we put up with a lot. You put up with a lot. Thank you. I appreciate it for all the questions.
Okay. Thanks, Joe. Appreciate it.
Yeah, it's interesting. They started off by complaining basically about debt management. I totally agree, by the way. I mean, let's break that apart into two things. One, Joe Manchin's complaint is that, hey, look, you know, we passed money in a balanced way via the Inflation Reduction Act. The problem is, and everybody knew this would happen, the Treasury Department is willing to extremely loosely interpret rules that were passed for or in this Inflation Reduction Act, which really the latest estimate is that Goldman Sachs thinks the Inflation Reduction Act is really not going to be somewhere around $380 million in green spending. It's probably going to be more like $1.2 trillion in green spending, which is just this massive stimulative force towards energy, but also debt. And the question then is, well, when does it go away? Well, that's where you kind of have a few options. You raise taxes, which nobody wants to see that. You dramatically cut spending, which you could go through like the 2010s version of the Eurozone debt crisis, where you had this mass austerity. Does anybody remember when Greece had, the failure to collect trash because they were going through austerity and no money? I couldn't even collect trash. And then the third option is you grow it away. That's probably the best option. Best option being, well, if we end up having some kind of massive productivity increase and we're able to grow and escape the previous debts that we had, then maybe they're not that bad, right? I mean, think about it. If you have $5,000 of credit card debt and you make $30,000 a year, that's a pretty big burden. But if all of a sudden somebody's like, hey, instead of you making $3,000 a year, you now make $200,000 a year, well, now all of a sudden that $5,000 of debt isn't that big of a deal anymore. The same could happen with a country in terms of GDP growth. The problem is, what if it doesn't, right? And I think that's where everybody's looking for a little more fiscal responsibility to make sure we don't fall victim to the other two scenarios of, well, then we need to tax more or have austerity or a combination of both. But it does make you wonder if and when we're actually going to see some more entrants into the race from the Democratic side right now. And obviously the most vocal is RFK. I think it's interesting that after Vivek entered the race, you have a lot more focus on Vivek actually than you do RFK. Like RFK was almost the pre-Vivek, and now Vivek's kind of taken a lot of that enthusiasm. That's not to say there isn't still enthusiasm for RFK. Let's look at the polls really quick just to see the latest. And I know people don't generally individually care about individual polls, but what I like doing is sort of just daily looking at the latest 2024 polls, and you kind of look at an average of all of them just to see how things are moving, the inflection points. I'm always looking for those inflections. And I think it's interesting that you still have, in most polls, DeSantis polling the highest out of Republicans over here. Iowa Republican presidential as of today, still polling at 14%. Here's the last one from September 11th. DeSantis 11, Trump 60, Trump 49 over here in Emerson. Ramaswamy a lot closer over here, Ramaswamy at 9%, whereas over here at 7%. And going down into February, similar though, 51, 14, 9 for Ramaswamy. And I did think this was interesting. As much as most people want to throw this company against the wall, CNN actually ran a poll judging the difference between who would win between Biden and Trump. And in that case, Trump would win by 1 point. And then CNN, and again, I know, consider the source, CNN ran the poll between Biden and DeSantis, and it was a tie. And then Biden versus Ramaswamy, and you ended up getting Ramaswamy winning, Biden winning by 1%. And if you put Nikki Haley versus Biden, Nikki Haley would crush Biden, again, according to this CNN poll. In fact, a lot of the other Republicans would end up crushing Biden. Pence, Scott, and Christie were all believed to actually beat Biden. Now, the odds of us getting to these names actually running against Biden might be a little lower. Maybe. Who knows? Things could obviously dramatically change. But these three were very, very interesting. That you're basically saying, look, vote for Trump. Otherwise, you risk a tie or a loss, comparing between the DeSantis and Ramaswamy options. Somewhat interesting. All right. Enough politics for now. Let's hop in over here.
To talk about it, saying, you know what, I'm not sure if we set the inflation target today, it would be 2. What I think is going to end up happening, Andrew, is exactly what you said. They're going to push 2 out more and more and more. We're going to live with higher than 2. And at some point down the road, we're going to make that transition. But we're not going to get an announcement of a different inflation target anytime soon.
And is your sense that they would, right now you think it's a pause. The market thinks it's a pause. And then the question is, are they going to lower rates later? Do you think there's a possibility of just one hike somewhere in between? And what would the market do and by the way, would the market have a heart attack if that was the case?
The market shouldn't have a heart attack, but what the market should recognize is we're high for longer.
I was going to say, if they don't lower rates at the beginning of next year, the first half of next year, does the market react poorly, the stock market?
I think the market will have to absorb this notion that we're high for longer. What we don't know, and there's a massive debate going on about monetary policy, is it the level or is it the rate of change? Have we seen most of the long and variable lags, or have we not seen most of the long and variable lags? So there are real questions about the design, the conduct, and the effectiveness of monetary policy that the marketplace right now is not absorbing. The marketplace assumes that the Fed is going to be able to cut rates early next year. I don't think that's going to happen.
Okay, in the meantime, you have other things that are taking place. Yesterday, Jamie Dimon was railing against the new capital requirements for banks, saying that that's going to slow things down in a big way, the amount of lending that banks can and will do as a result, and that will have an impact on the economy. Do you worry about that?
I do. I think Jamie is absolutely right in saying that higher capital requirements is not the answer to what happened in March and April. March and April was a problem of supervision, that the problem was identified, but nothing was done to force these banks to deal with the maturity mismatches. To then react and increase capital yet again is not the right policy response. And there was a risk that that will not just lower credit, but push it into the non-bank segment. And that segment is well less supervised and regulated.
I was going to ask you to move on to crypto, if you'd indulge me for a second, because we always have these crypto conversations. And there seems to be this thing happening. I don't know, Joe, we were talking about $25,000 with Bitcoin. Meanwhile, BlackRock and all of these folks, all the folks that we thought were never going to do this are now doing it. And yet it's not moving at all.
Well, it's moving today.
Well, sure, 26. This is 26.
It was 4 when we started saying it wasn't going anywhere. 4,000.
Oh, well, okay. But the question is this now a risk on, a risk off thing? How do you even correlate this to what's happening with the Fed? Because for a long time you used to talk about crypto in regard to the Fed.
So I think crypto is settling as part of the ecosystem. I think people have recognized it is not the new global currency. People have also recognized it's not going to disappear tomorrow. It's becoming institutionalized. And I think, actually, if I were a crypto person, I think this maturation process is a good thing. Where it moves from day to day is, I can't really comment on that.
I still think it's outperformed every asset in 1 year, 5 year, and 10 year.
Might have.
No, I think it has. So I don't know whether, I don't know whether 20.
I don't know about the 1 year.
1 year
but
17, I suspect
1 year.
the Nasdaq has outperformed.
From it was last year, it got as low as 16,000. So it might not have outperformed everything. It's outperformed most things.
Yeah, I think year to date it's 17%.
Well, I don't know. I said it
Yeah.
like in the last year, 1 year period, 5 year.
I'll check.
I don't know.
I'll check.
But and we know that really good stocks can have similar moves. I mean, stocks can go from 65 to 26, and like a lot of well-known stocks, as we now know. I mean,
I think if you like
Netflix, 700 to 180.
Right.
It's a great
Peloton.
company.
I mean,
Great company, right? So I mean, there's volatility. Depends on what someone will pay for. Everything depends on what someone will pay for it on that day.
I like your Jets tie, by the way.
People said that I'm going to bring up the Jets with you. How long will it take? So I'm not bringing it up. I'm not going to be predictable.
I really like
Congratulations. I wore that for you. Who's the quarterback? Zach?
But look at the defense. I mean, yesterday, I must
Great
tell you,
coach.
Great coach, and inspiring performance. Most teams.
You always congratulate me on the Bengals. Have you seen a bigger mess of that game on
Against the Browns, right?
Yeah.
Yeah.
$55 million a year for I mean, it was raining. But it was raining. Was it not raining on the Browns?
It was raining on the Browns.
I know it was. So I don't know what happened.
All righty. So let's see what is. There it is. Today is obviously the eve of a CPI, so buckle up for that. So we've got on top of that the Apple event today. Apple event should be entertaining. A lot of folks thinking, okay, this is going to unleash a new super cycle. Wedbush making that argument. Others suggesting, no, this is a marginal upgrade, and the change of the charging port might actually end up hurting sales, which, I mean, one thing I think about is, I mean, I got plenty of USB-C chargers, but I have them all set up for my iPads everywhere. And now I have to go through and go replace at least half of my Lightning chargers to more USB-C chargers. So I think the interesting thing about changing chargers here is you effectively end up increasing the price of the phone, as people now not only have to get USB-Cs, but then is it a USB-C that's capable of charging? It's crazy. Anyway, so we have the different wattages for these USB-Cs and such. That's nuts. But anywho, the iPhone event is going to take place at 10 a.m. Today, so it'll be pretty entertaining. 10 a.m. California time. So usually that ends up lasting somewhere around 90 minutes or so. The event's called Wanderlust, and we'll see how exciting it is. We covered last time some of the things that we thought would be interesting. Probably one of my favorite things that I'm looking forward to is this idea that you can have the little switch on the side be used to set your do not disturb mode rather than just silencing the phone. Given that the do not disturb mode, sometimes you'll turn off do not disturb, but then you're still stuck on silent. It's like two steps as opposed to making it just one quick little physical step that actually shortened the cycle of being able to get in there and actually turn it on or off anyway. So that's probably the only thing I'm excited about, which isn't that exciting. Of course, we'll see if there's anything else that's super exciting that's announced. Obviously, we expect camera, battery life, processing talk, the good old usual Apple event stuff. So we'll see. Okay, so now we've also got yesterday I went through with the team of research again, and we grabbed this piece on Tesla that I think a lot of folks have really forgotten. Pull this up here in a moment, and we'll chat about this number, which I think is pretty remarkable, but also very, very useful So we'll give this a moment to come up, and we'll chat about that. Obviously, Tesla had a pretty big day yesterday. Pretty remarkable. Oh, look here. They're talking about the Apple event as well. Let me pull this up. Well, let me see what they
At
say.
an event in California today, if the company's naming pattern stays the same, this would be the iPhone 15. Reports say 4 models are coming, 2 lower end and 2 higher end. The charging port is also expected to change to USB-C from the Lightning standard that Apple has used since 2012. The company's hoping the new models will juice phone sales and help them recover from a recent sales slump. We will have coverage of the Apple event on CNBC all day long. You can see that stock right now up by about 39 cents. Let's take a quick final check of what's been happening in the broad markets. Right now, you'll see the Dow futures off by about 71. S&P futures down by 14, the NASDAQ off by 51. Of course, this comes after 3 days in a row of gains for the Dow. Folks, that does it for us today. Make sure you join us.
All right, so here you go. Take a look at this stat from Tesla Twitter. And this is actually from Bank of America, but I Tesla Twittered it or Tesla X'd it. This is important. If you're an investor in Tesla, you've got to know about this chart. So I'll read this out and then I'll explain the chart. A few months ago, I warned that Tesla was heavily undercapitalized by institutions. I also warned that last week, by the way, when I reiterate it once again. Tesla's really undercapitalized. In other words, institutions aren't really investing in Tesla, especially after Bank of America released this chart, which we're going to go through in a moment. The chart basically says only about 35% of funds have exposure to Tesla at all. That's like having 1 share of Tesla, right? Only about 35%, or rather of the 35% that do have some exposure to Tesla, the overall average allocation is very low. That's kind of like saying, hey, if everybody in the house owns 100 shares, I own 20 shares, right? So in other words, there are a lot of people who just don't own it at all, and then those who do are relatively underweight. This is compared to something like Microsoft, which 90% of funds have exposure to Microsoft, and institutions are overweight on Microsoft by 20 to 30%. And 50 to 75% of funds own Amazon, Google, Nvidia, Meta, and they're on average 20 to 60% overweight. Basically, Tesla has the worst of both here. Low amount of funds holding it and a low allocation within those. Now, that could actually end up being a good thing for current buyers because when sentiment changes, more institutions have to buy Tesla, more institutions have to increase their allocation who have already bought Tesla, and all of it leads to more buying pressure on Tesla. Bottom line, it's bullish. So here's that chart. This is straight from a Bank of America report. We generally go through these reports every single day. This one we definitely bookmarked and wanted to keep an eye on because we thought it was so incredible. It basically just depicts what I've described here and shows you how Tesla's there at the bottom left. That bottom left, again, representing the lowest portion out of all of these companies listed here. It is the least allocated mega cap. And then within being the least or within all of these stocks, it is also weighted the least, although it's somewhat similar to the weighting there of Apple, though many more funds have exposure to Apple at somewhere around maybe 60% of sort of the market's weighting. So I found this very interesting, putting Tesla all the way at the corner over here, whereas you put Microsoft at completely the opposite corner. You've got Facebook over here at nearly the opposite corner as well. I originally thought that Apple was actually over here at not only in basically everybody's fund, but also heavily allocated. But it wasn't actually that heavily allocated. It was just in everyone's funds. It was more the Microsoft, the Amazon, the Google. And some argue that this is actually because Apple hasn't really embraced the idea of, oh yeah, let's pitch AI as much as everybody else is pitching AI, and that they may have left some money on the table as a result of that. Though many just argue, no, Apple's being realistic and they have artificial intelligence and they have language models and they incorporate this into what they do. They just don't like to call it, AI for the sake of trying to pump the stock. So it's one thing that on the flip side, people actually say, all right, well, maybe that's respectable, Apple. Thank you. Either way, this Apple event will obviously be a big deal for Apple, mostly because there are, at least in my anecdotal world of what I'm hearing from institutions or commenters on this, it seems like people are more bearish on this Apple event than any time before. I will say, after having gotten a new iPhone every single time since the original new iPhone, this is the first one where I'm like, do I really want to, go through setting up yet another phone, or going through and getting all the different, USB-C cables where I have lightning cables set up? Do I really want to get a new dock for it over here where it sits on the desk? Do I really care? I have an iPhone 13 and a 14 right here. I barely notice the difference between them. In fact, I most of the time don't notice a difference at all, with the exception of the fact that the 14 has the always-on display, which I think there's some use to that, especially if you're just trying to watch for like messages coming in, like texts or emails or whatever. I think that has some function, and that would be a benefit of upgrading from the 13, because you're getting the always-on display. But some people actually get a lot of anxiety from that. Like, no, I'd prefer not to have that. So anyway, but back to this idea about Tesla here. This overall is a great thing for Tesla. And we touched on this not only last week, but we touched on it months ago. We touched on it yesterday. But one thing that is worth highlighting, which we also talked about yesterday, is good old Jim Cramer. Jim Cramer saying he does not like/agree with the Morgan Stanley price target hike of Tesla. Was actually, in my opinion, extremely bullish for Tesla. So it looked like a few of you also agreed. Some of you in the comments went as far as saying that Jim Cramer saying that was actually more bullish for Tesla than the analyst upgrade itself. Anyway, there you go. All right, let's listen now to, the Snowflake CEO. Let's take a listen to this.
The corporations themselves. And, many are sort of debating right now, how much do I show my hand and how much don't I? Will I get credit in the marketplace for it?
There is no hand to show.
For being too promotional, but it's an interesting time when it comes to generative AI.
Yeah, definitely.
In that regard.
I think, yeah, and what you get is like Progressive is you see them, the auto insurance company. They're huge users, and they're able to price insurance instantly where it should be. Remember, this is something that Frank discussed that I think, again, people at home have to understand. It's about, David, picking up a couple of basis points millions of times. Whether you're a bank, whether you're an auto insurer, whether you're financing autos, that's another big business. Where insurance for flood areas. These are things he's meant. These are use cases where you have to be so right that nobody's smart enough as the machine, and they're boring. But for a guy like Slootman, who can go in and say, listen, you save $10 million a week just by doing nothing except for giving us a little bit of money. David, it's a great use case. It really is.
Jim, how about Ellison's comments about the people, or I guess not the people, who are going to rewrite the Cerner code base? It's not armies of programmers that are going to be rewriting this.
I think, boy, Ellison made it sound like, no, you go to one of our data centers, there's nobody there, so there's no mistakes. You make a mistake with AI, you press a button, the mistake is changed everywhere. I mean, Larry is chasing out a vision of productivity that was similar to what Jeff Lawson from Twilio traced out. You get 10 times the productivity, 10 times the gain for 1/10 the cost. And that's pretty much what Ellison is saying. He'd say, listen, you go to our data centers, there's nobody there, and therefore there can be no mistakes. Carl, very futuristic vision. I hope there's a job for people, because boy, when he's done, you don't need people.
Well, what I've heard as well, though, guys, and Carl, to your point, is that you can hire programmers who may not be the best because...
By the way, I think that's actually a really interesting insight. It's like, oh yeah, you go to the data centers and there's nobody there. Honestly, that's probably the direction a lot of jobs are going to go. And it breaks my heart, because I really do worry about what's going to happen to individuals who do not have some form of a skill set. It really makes me nervous that people are... Basically, let's put it this way. The rich are going to get richer, and the poor are going to get a lot poorer before there's ever UBI or Ready Player One kind of, excitement over, okay, well, maybe it's okay. Maybe we don't have to have a skill and do anything. We can kind of just sit here and exist. That's sort of the long-term utopian goal, but quite frankly, for anybody watching this now, I think, yeah, it's probably not what you want to sit around and wait for, because if you're waiting for that, you might end up pretty miserable between then and now. And that's not to say that money is the root of all happiness, but let's just say it's been studied that happiness certainly goes up when you can pay your bills. There's definitely a clear link between that. But then you regularly get stuff like this. See here, Wall Street Journal, fast food workers in California are poised to get a $20 minimum wage next year under a deal between unions and restaurants. And on one hand, you're kind of like, hey, look, that's fantastic. People can actually deal with the inflation that has occurred. People can now maybe start surviving again off of a skill or a job that's actually relatively low skill, right? I mean, I took a job at Jamba Juice back when the minimum wage was $8. And so I don't know how to make a smoothie. And they're like, here, we'll teach you. And then, after a day and a half, you're like, okay, I kind of get this. And then, you're kind of like cheating at the recipe sheet and you're making the smoothies and you screw up and then you get better and better and better. But after a couple of weeks, you're like, all right, yeah, I can make you a smoothie and stick the straw in it. Like, it's not that hard. So eventually, though, that'll probably all get replaced by Tesla bots. And the problem is, the more these minimum wages get negotiated up, the more Tesla bots or Optimus robots or other robots are actually incentivized. Now, that's not to say that robots are here around the corner, but the point is, probably within the next 10, 20 years, we're probably going to have a lot of these jobs replaced, just straight up replaced by robots. And the issue with that is, well, what are people going to do now? That's not to say we shouldn't have robots, right? We don't want to turn into Luddites who are like, okay, well, let's hold back the economy and not have robots. No, not at all. I mean, one of the things we should do is get people out of dangerous working environments, certain factory environments or toxic air exposed environments like certain painting jobs or otherwise. These are things where, ultimately you probably want to minimize your exposure to. So, like even chrome plating as an example, right? Chrome plating is a perfect example of a toxic job that, I mean, obviously you need to wear a respirator, but still being surrounded by it on a daily basis is probably likely to end up causing cancer, which is terrible. Point is, there are certain jobs that robots should definitely do, and then there are jobs that robots will do, and robots will do jobs where it is profitable for the business to put the robot. We've already started seeing fully autonomous fast food chains. I mean, now there are vending machines that'll literally microwave a hamburger for you, and you'll have a hamburger come out or a slice of pizza come out. It's crazy. But it'll get more and more like that. So my big concern for all the individuals is what are folks doing to make sure that in the future economy, they're still going to be able to provide value? And I know a lot of people that would take this sort of counter response of like, well, I'll worry about that when the robots come. The problem is, if you're 20 now or 25 or 30 now, and you're doing a job that could get replaced by a robot in the future, you have to ask yourself, how hard is it going to be to transition? Not now, but how hard is it going to be transition for you in 20 years when you're 50? It's a lot harder to be like, oh yeah, I'm going to go get another license when you've got kids and bills to pay and a house and, you have less energy because now you're 50 compared to when you were 20, right? I don't know. It's the direction things are going though, so I'd pay attention to it. And certainly you don't want to be stuck on the wrong side of that innovation curve.
And Bruce Flatt certainly made that clear in a conversation.
Oh, yeah. And this is a good point. Opstar says course plug imminent. You're right. I forgot to mention there's an expiring coupon code this Friday. We're doing away with some of the entry prices for some of these programs. So in other words, we'll have a larger bundle. But anyway, there'll be a big price increase for all the entry options for these courses that we have, which are our most in depth and really incredible courses. And I think you'll get a lot of value out of them. So check them out at meetkevin.com. You can also see links to financial advice, shadowing, ETF, and everything else there.
Products that we offer them offer because they don't have liquidity, they get a better return. But more importantly, I think there's less distraction in the private markets.
What does that mean?
Just every day when you're quoting the bond markets are up, the equity markets are down, and all those things are happening out there. If you're an investor, it's just a distraction.
So we're a distraction. Thanks, Bruce. Well, we're going to be following the company regardless. Later today, they do have, later this morning, they do have an important investor day, of course, introducing targets such as 2 trillion, Jim, they expect to manage in assets, 2 trillion within the next 5 years.
They're everywhere. They, by the way, Wes Eden's a symbol, I think, in Fortress. These guys are just so much, they're like Prometheus. You know what I mean? They're like lifting the world. They're doing infrastructure, but they're doing banking, doing real estate, and
Renewables. Yep.
Yeah, and David, this is a great score for you because I've always tried to figure out who is Brookfield. I mean,
all right, whatever. Folks, we need to talk about the consumer, and it is not good. We've got a UniCredit piece here, followed up by a Bloomberg piece. We're going to go through this. Let's give you the bottom line on this. We need to understand this because it's going to affect your investments. All right, take a look at this. UniCredit, what do we got? All right, here we go. Look at this. Real personal consumption is the red line. Real personal disposable income is the black line. As you can notice, there's a gap. This widening gap creates this concern that the only thing that's potentially been propping up this gap has been that magical phrase known as excess savings. Right? So if I kind of color in this little gap right here, this gap is built up by ES, excess savings, thanks to COVID buildup. Well, there's the potential that once that excess savings is gone, what you end up having is some kind of crash in real spending here to much more align with your typical real disposable income line, given that you usually have that sort of alignment in non-insane COVID periods. So you look before that, you generally have a convergence of the two, especially if we're going back to 2019 world. 2019 world, you can see that convergence is very, very tight. Tight. Unlike what we have over here, which is just so you can see it again, we'll visualize that a little bit better without my drawings all over it. You'd see that gap is pretty wide. So the reacceleration, of the U.S. consumer over the summer has led most Fed officials to maintain their tightening bias despite progress on disinflation. Look at that, meaningful progress on disinflation. The chart above shows that the spending spree, though, is on shaky ground as personal consumption is unlikely to be able to decouple from personal income for much longer. Spending can temporarily outstrip growth, either because consumers dip into savings or they finance purchases through higher borrowing. This is what Americans have been doing over the last couple of years. However, the Fed's Beige Book last week reported that the surge in demand for hospitality and tourism over the summer was, quote, the last stage of pent-up demand. This isn't good. A lot of folks still really believing that Airbnbs are going to come back. I personally think Airbnbs are in a big bubble. And don't get me wrong, I'd love to go buy Airbnbs because you can squeeze a little more cash flow out of them, but you'd be very careful buying in a bubble. So you got to be very, very careful with where you're buying and what you're buying. Anyway, the report suggests that consumers may have exhausted their savings and are relying more on borrowing. This fits with our estimate that the bottom 40% of the income distribution has completely exhausted their savings buffer, in large part due to high inflation, eroding households' real stock of liquid assets. All this means, at least, is that consumer spending growth is likely to follow more closely that of real disposable income going forward. And given that labor income is slowing as higher and wage growth ease and lower headline inflation do end up supporting real incomes, you are going to end up having this potential unlikeliness that consumer spending will stay this high relative to incomes. In other words, we're going to see this kind of squeeze between the two. This is actually one of the reasons, probably now at this point, a few months ago, I ended up finally closing out my Etsy position Etsy and the consumer discretionary stocks are stocks that I believe will do well once we actually go into true consumer recovery mode. But I'm not convinced that we're actually near consumer recovery mode, given that we still have this wide gap between consumer spending now and incomes, suggesting that maybe the rest of the squeeze is actually still in front of us rather than behind us. Anyway, top 20% of earners spend 4 times the amount of the bottom 20%, but the top 20% only spends 53% of their income, compared to the bottom 20% spending 100% of their income. This is basically a way of saying the wealth gap widens. It's not a terrible surprise. This is very, very common. Here's your average American household. 73% of their total income gets spent, which unfortunately, once you consider taxes, doesn't leave very much for savings. Social Security, look how they had to add up savings over here. Social Security takes $8,300. They're considering that part of savings. Oh my gosh, you really want to rely on Social Security as your savings? Oh, smokes. Average American household only spends $558 on alcohol. That seems a little low. Health insurance, $3,400. Gas and insurance, $4,800. Vehicles, $4,000. Vehicles. Well, if you have 2 vehicles, it's actually not bad, because that would work out to like $180 a month. That's actually not horrible. Although this is probably ballooned, because you get a new car now, you're paying like $800 a month. That's like $9,600 a year. It's insane. $1,300 a month for our phone. Look at that. A paltry $1,500 a month for education. I mean, this should be like way higher. Spend more on educating ourselves. Now, look, I know maybe I'm a little biased because, okay, I sell courses on education and building your wealth through real estate and getting out of the rat race and making more money and building your income with AI or property management or do-it-yourself rental renovations or real estate 0 to millionaire, right? So I get it. But I will say my entire career has been based on the idea that you should always learn learn more, A, and B, how could you apply those things that you're learning for to basically make more money? That's the key. What can you do? How many more licenses can you get to make more money? Here's the bottom 20% spending $25,000. No surprise that, and probably rightfully so, their education expense is half of that of a $73,000 income household. One of the first things that gets cut is education. It's pretty wild. Interesting piece here. And then, of course, the highest 20%. Oh, my Lord. What a shocker. Those making on average $99,000 spend 2.5 times as much on education as the $73,000 household. So in other words, they make an extra 25 grand, but they spend, I mean, look at this. It's 4,000 divided by 1,500. 4,000 divided by 1,500. Yeah, it's 2.6 times. So the $99,000 household on average spends 2.6 times as much money on education as the $73,000 earning household. And the $25,000 household, and I know there's a limitation here because you have to be able to survive. Okay, I get it. But it just to show, again, the wealth gap, the $25,000 household spends 5 times less on education. That's absolutely insane. I'm going to write that down. 5x less on education, and then over here you are. That's the 5x less on education is over here, the $25,000 segment, and then of course over here we have the 2.6x less on education compared to that $99,000 group. That's incredible. It shows you one of the priorities. Education is a big deal. Now, you also get a bump, obviously, on vehicle expenses and housing expenses. I mean, everything's higher, but they do indicate a larger basket of savings here outside of just Social Security, which that's good. So either way, fascinating piece. Let's go now look at what we're getting from Bloomberg, because this is going to weigh on consumer spend. The question is where it's going to show up. Bloomberg just ran a piece that argued that consumers were about to hit a wall. After staving off a recession for longer than many thought possible, the U.S. consumer is about to crack. Oh my gosh. That's not good, man. People are like, hey, man, you get some people are like, it's Trump's fault. And then some people are like, no, it's Bidenomics' fault. And then other people are like, it's RFK's fault. It's like, wait, how's that his fault? I'm kidding. But anyway, so what do we got here? More than half of the 526 respondents say that personal consumption, the most important driver of economic growth, will shrink in early 2024. So just so you know, in case you don't know what this MLive survey is, basically any loser sitting in their boring desk with a Bloomberg terminal subscription can fill out the survey. And some people have argued that the survey participants are the less busy of the Bloomberg terminal users, because if you were really busy, you wouldn't be sitting there filling out a survey. And so that there's maybe a skew towards negativism in these MLive surveys. Now, I actually think the MLive surveys are interesting to look at because I do kind of like to see what terminal users are thinking. But that's one argument that people make. I think that's it's a harsh argument, going as far as calling people losers. But other people they say these things. I don't know. I thought it was interesting. But then again, you could say the same thing about businesses, right? The businesses who take the time to respond to these surveys about how well the economy is doing, they ain't the busy businesses. And again, I mean, maybe it shouldn't be that way, right? It's kind of like maybe busy people should actually say they got their jury duty invitation, right? But the reality of America is that you find when it comes to these sort of surveys, whether it's election polls, market surveys, whatever, business surveys, it's the people who are stressed out, really busy because they got a test coming up, they got deadlines coming up, they're cranking, they need to hire more people, they're producing. They're like, bro, the last thing I can think about on my plate right now is a survey. Anyway, so it's something to keep in mind. So, but anyway, more than half. Okay, fine. So what? Like half? Okay, call it 55%. Said that personal consumption will shrink in early 2024. That's interesting. There actually is a lot of talk about this early 2024 narrative. And this early 24 narrative is also built up by the bears who argue that, well, I mean, inverted yield curve, 2024. Yeah, we pushed it back from Q3, Q4 2023, but we think it's going to be early 24 now. Okay, fine. So anyway, which would be the first quarterly decline since the onset of the pandemic. Another 21% said the reversal will happen even sooner in the last quarter of this year. Okay, well, that actually puts you closer to about 71% of these market respondents, suggesting consumers are about to hit a wall. The finding is at odds with the optimism that permeated, U.S. equity markets for most of the summer, as cooling inflation and low unemployment bolstered hopes that a so-called soft landing would occur. Keep in mind that you have to consider consumer stocks for a moment. Consumer stocks are going to be stuff like, Disney. Now I understand. I'm going to get a lot of the, oh, no, Kevin, go woke, go broke. Okay. I got it. There's Disney for you, okay? Then what about like Etsy, another consumer stock, right? Oh my gosh, it's at the bottom of the fibs. It's trying to break through. That's not great. What's another example of a consumer stock? So let's go to like Visa, for example. See this weird tale of two cities, right? Like on some extent, people argue that, well, the credit card companies are doing so well because people are trying to prop up their spending. And in order to do so, they're borrowing. And quite frankly, defaults are a lot lower than have been expected. American Express trading a little bit more mid-range here. But let's go ahead and look at something like Marriott. Are these sort of companies at risk? I don't know. It's at like all-time highs, basically, based on, yes, forever. So, how about like an MGM? So there's no clear-cut stock market trend that says, oh, every consumer is screwed. I mean, you can look at COVID plays like a Macy's and go, okay, well, all are no data. Oh, is that so? You look at like a Macy's and it's like, oh, damn, Macy's got hit hard. What happened to Macy's? Well, maybe investing in malls wasn't that great of an idea anyway. Although during COVID, I did think there was a period of time where investing in Simon Property Group was entertaining. I remember buying the sucker back at like 40 to 70 bucks. It's still at 114 bucks. Somehow the malls are still there. It's still surviving. Although I will say there's some malls that are really killing it now and that they're much more entertainment focused, right? Like you go to a mall and you do your virtual reality fighting and then you go have a beer or, I don't know, a Diet Coke if you're Mormon. or whatever. It's more based on doing stuff. But again, there's this talk that the consumer is going to hit a wall, which somewhat aligns with what we just saw from UniCredit and this household spend over here. It certainly aligns. Could mean more downside for stocks, true, but they should specify which stocks, right? If you're wealthier consumer who's more exposed to real estate equity and stock equity is able to enjoy the benefits as usual, the rich getting richer, right? Rich get richer. You have to ask yourself, well, if rich get richer, what do rich people have exposure to? Real estate exposure. And then what else do you have exposure to? Stock exposure. We know real estate exposure is heavily associated with the wealth effect, but there's also some too high wealth effect understanding in stocks. This has been debated and people compete over how much of that wealth effect is actually true for stocks. But the point is, you have to ask yourself, what are those folks going to spend money on? And let's think about that for a moment. But we do have the bell here. We always enjoy listening to together.
The big board.
But as we can listen to this in the background, ask yourself, what stocks might be better positioned?
David is going to talk to Endeavor CEO Ali Emanuel and COO Mark Shapiro in a few minutes.
There you go. I'm surprised they didn't show the NASDAQ this morning. But anyway, so rich getting richer here. Well, I would say, what's going to hurt? Well, what has been hurting has been like the Dollar General, right? And Macy's has been hurting. Obviously Disney, but I'll put a little asterisk there for the whole like woke thing. Honestly, like when I like, and this was probably a year ago when all this like go woke, go broke stuff was really starting with the companies. I know some people are going to go, Kevin, it was always happening. Okay. I asked Lauren, I go, hey, Lauren, how much do you actually think the whole like go woke, go broke stuff is actually going to affect sales at these companies? And it's one of the reasons I love Lauren so much. She's got this perspective that sometimes I'm kind of like, I don't know, like, is it actually going to affect spending? And she's like, oh yeah, it absolutely will. I'm like, oh, okay, and sure enough, like it does. So like, yes, Kevin, it does. People's beliefs and preferences absolutely dictate their spending. So that was very interesting. So anyway, on the poorer side, obviously you're going to get hit at some of these companies. So, but then the question is, right? This is the question: if wealthier folks with exposure to assets going up, thanks to no massive recession or Paul Volckering, if all of a sudden that's okay, then what potentially benefits? I don't know. Does Apple benefit, which appeals to a wealthier demographic? Does Tesla benefit? Does an Enphase bill benefit? Does a Generac benefit for home batteries? Does you have to ask yourself, an LVMH, where does LVMH sit? Well, often and ironically, like an LVMH can kind of sit in both places, probably at both ends. The reason for that is you get a lot of spending at LVMH that's actually driven by people who want to feel like they're able to reward themselves with a product that they couldn't previously afford, and they've worked towards something or they've earned something. Basically, people who want to appear maybe like, they've accomplished something more than they should be spending their money on. I don't think there's anything necessarily wrong with that, but the point is, you lose a segment, it's going to hit your LVMH. Whereas like, somebody who's working at Jamba Juice is not worried about putting in a home backup system for their home. Obviously some of these stocks have, especially the solar industry, have absolutely gotten destroyed. But it does make you wonder if you could return back to this differentiation between where consumers are spending. I mean, yeah, you're not wrong. I see somebody's comment here. You piss off half your base. People aren't going to come. Kind of like the whole like Bud Light thing. Exactly. It is true. So anyway, then we have likelihood of a soft landing, falling inflation, and end to the inflation fight, and a peak in interest rates, stable dollar, stable oil prices. All of those things help drive the market up in the summer. If the market loses confidence in this scenario, then stocks are vulnerable. Well, yeah, that's entirely possible. One thing to look at is oil, for example, up another 1.3% at $92. It's kind of impressive. I have to say this no recession thing is really driving these oil prices, and that's another thing that's going to whack the consumer. I mean, consider for a moment. Do we have it here? Do we have gas spending? Yeah. Look at gas spending for a moment. Okay, I think this is so fascinating. Ready for this? If you make an average of $25,500, you are spending on average 25,525. You're spending an average of 8% of your income on gas. 8% on gas and insurance. Okay? Now, compare that to the 70, or sorry, what is this? What do we have over here? This is the total income 73,000 group. Okay, so 73,000 group, how much are they going to spend on gas and insurance? 4,810 divided by 73574. Here you're spending 6.5% on gas. And then now you go to the 99,000 group. Oh, well, that's spending 99,000. Whoops, it's actually total income of 188,000. Oh, okay. So definitely a big difference here. So what do we have here? Well, they're spending on gas. You have 8,142 being spent out of $188,000 of income. You're spending just 4% on gas. So another example where even your gas expenses are half as much when you have more income. So it just affects you less. So let's continue on here. Let's see. Growth is forecast to accelerate in the third quarter on the back of the recent pickup in household spending. That would be the third quarter of 2023. But the big question is it sustainable? Well, I guess we'll see. Plenty of headwinds looming. Fed Reserve Bank of San Francisco says excess savings that help consumers get through the price spike will run out in the current quarter. The buffer is almost gone for all levels of income. Lower level of income already probably dwindled out to zero. And of course, student loan debt. I don't think this student loan thing is going to be as much of a cliff as everybody talks about, mostly because I think it'll be more of a gradual onset, thanks to Biden's policy that you don't actually have to start making repayments until next year, which is kind of remarkable. That ended up getting pulled off. I know a lot of people were actually hoping for like some real support, which was removing some of the burden of this student loan debt. But oops, that did not end up happening. So anyway, long and short of it, yeah, there probably and almost certainly going to be aspects of the consumer that just end up getting smashed and hit a pretty hard wall. And so the question will be how this next year evolves. And I would say buckle up. Buckle up. You know, that's why I personally have a bias towards investing in stocks that I think are disconnected from the individual lower 50% of consumers. Like the lower 50% isn't buying the NVIDIA chips. They're not buying Teslas. They're not buying iPhones. They're not buying solar inverters. They're not buying solar batteries. Well, energy batteries for your home. They're probably not buying real estate, right? It's just all of this combined that leaves me with a bias. Even if I look for value companies, you know, I'm more interested in a value company like Intel than I am like maybe a Dish Network, specifically because Intel has the wind at its back of artificial intelligence and manufacturing and, isolationism to the United States. Quite frankly, Intel killing it right now. It's at $39. I have been begging people to consider investing in Intel since the sucker, I didn't get it at the bottom. I'll be transparent. My exposure to Intel started around 29 to 32 bucks. 29 to 32. It's not a meme stock, but it is, in my opinion, still a value play. And this is a value play that isn't exposed to in my opinion, sort of the, dare I say, the lower income consumer. This is the wind at Intel's back isn't even about, Intel chips. Nobody cares. Intel chips, who cares? Intel chips don't matter. What matters is that this is going to be the fab of America. And, you get a Trump coming back or some kind of increasing pressure on China and less of a reliance on Taiwan. you're going to want exposure to Intel, in my opinion. Not personalized financial advice. I'm a licensed financial advisor, but I have to be really careful, okay? Or we're going to get in trouble. It is not personalized advice for you. But anyway, look at this. This sucker's trading for $39.38, okay? It's next year's EPS is expected. It's expected to end 2024 with $1.74 of EPS. $1.74 of EPS puts this sucker at 22.6 times earnings. Okay, well, Kevin, what's the growth expected to be after that? Oh, you really want to know what Intel's growth is expected to be based on Wall Street's estimate in 2025, 6, and 7? Well, buckle up, because you're about to fall off your chair. This is just a Wall Street estimate. Could be worse, could be better. But anyway, 35.9%, 69.7%, 32.4% divided by the 3 years forecast. That's a 46% a compound average annual growth rate. 46%, okay? 22 PE. You see where I'm going with this? 22 PE divided by 46%. You see where I'm going? It's a PEG ratio of 0.5. This is a dirt cheap stock. This stock could literally double. In other words, be selling for $78, and it would still be at a 1 PEG. That's how much it's hated. That's how much Intel is hated right now. So, yeah, and it's got a dividend yield of like 1.7%. By the way, if you happen to purchase it in an actively managed ETF, those dividends flow through to you. If you happen to find an actively managed ETF that, happens to have like, I don't know, a 5 or 6% exposure to Intel, just saying. Just like I'm saying this coffee is also pretty good. So, what's next? Well, what's next is, I don't know. Oh, yeah, of course. Did I mention that this Friday there's an expiring coupon code you want to get? And it's a big one. It's actually going to be a big one. All of the existing products are going to be a lot more expensive. And that's because the value in these we think is so masterful and extreme, and we keep adding more value. But as a course member, you get massive discounts on shadowing me if you want to come shadow. You can bundle up with financial advice as well. That's over at StackHack. It's too complicated to pitch multiple websites though, so just go to meetkevin.com. You'll see the little things at the top. You can click on the different buttons or check out the different programs. But yeah, do take a peek at that. I know there are a lot of you. I don't know. I mean, give me some reasons here in the chat. Why haven't you joined the courses yet? Because we get thousands of people every day in the course member live stream playing these back either on 2X or they're there live, looking for the perspective that we're sharing and building in the course member lives. And I think there's a lot of value there to the content in the courses and otherwise. So check those out, link down below. All right, so that's a big piece there on El Consumer. Corset Creator says, after your evaluation of Intel last month, I bought in at $29. Nice. It's amazing. That's awesome. Congratulations. Affordability. Okay. I get that. Okay. That's honestly, that's a fair for Outcrowd thinks it's for PDF files. It's not for PDF files. That's okay. I respect that for the folks though that say that some of them are too expensive. There are options that aren't that expensive. I want to say the lowest option course is somewhere in the 300 range. Just go to meetkevin.com and you can see and pick it around. But yeah, that's true. Some of them are a little pricier, like the real estate ones. Okay, that's fair. That's fair. Okay, so let's see here. Let's see. What do we have? All right. Welcome aboard, Chuck Bono. Next up. I don't know what's next. Let's figure it out. Let's. Oh, you know what we should do? We should see how the sticks are doing. Ready for the sticks? Let's look at the sticks. Let's see here. So let's sort by down. Who's the loser today? Rocket Lab, Rite Aid. I mean, Rite Aid's suffering. Oh, well, that was from yesterday. I just updated. But Rite Aid and Walgreens not doing well is not a surprise. That's really sensitive to the consumer. but also the COVID boosters. They got a boost from the boosters. And honestly, I mean, like, I'm going to run a poll here. How many people actually still get the boosters? Let's see here. Start a poll. Do you still get the booster? Yes, I get the booster. No, I don't get the booster. Start poll. All right. If you're watching now, you could list or vote in the poll and let me know if you actually still get the booster. But my suspicion. I want to see what people actually say. Is that the number of people getting? But I am curious to see what the percentage is. Without looking to get biased, I'm going to guess only about 20% of people still get the booster. Again, I'm not trying to encourage you to vote a certain way. Just vote honestly. I mean, it's anonymous. I mean, to the extent that the CIA is watching, I don't know. Anything's possible. But I know who cares. They probably already know anyway. If you get your booster or not. After all, you get chips. I'm just kidding. So anyway, what else is going on in the chips here? In the chips, in the sticks. Amazon's down 1%. Whatever. Who cares? Some of this basic fluctuation crap. HUD 8 mining 8%. I think that's because BTC is up a bit today. Coinbase up 3.8. Yeah, just BTC Ethereum moving up nicely today. OLED, C3 AI, Disney's actually up 2.5%. Interesting. Affirm, DocuSign. So some of the ones we got punished yesterday are up today. Rivian's up. I wonder how Tesla's doing today after that 10% run. And usually after a run like that, it's down like 1% or so. Oh wow, it's actually green. That's pretty impressive. Oh yeah, look at that. It really wants to be aggressively green. Oh, now it's going red. I'll just stop looking at it. Oh, end phase. No, that's not end phase. Oh, end phase. Oh, it's flat. All right. So let's go ahead and see what people are arguing here. So what do we got? We've got, oh, wow. I'm actually surprised. 92% say they do not get the booster. Just 8% out of 500 votes that came in, within a minute here. Just 8% say they get the booster. That is way less than I thought. That's very, very interesting. Yeah, okay. I mean, even if the amount of people getting boosters is twice that, at 15% or 16%, still that's gonna hit your Rite Aids and your Walgreens and all that. So now here's a different question. Okay, ready for the. So let's end this poll. Here's another one. All right, this is a better one because I think this will actually relate to investing. So ready for this one? Start poll. All of the other one does too. Do you or would you consider weight loss shots like Wegovy and Ozempic / others? Yes, I'd consider. Yes, I already have used. No. Start poll. All right. Okay. So the reply, no. Somebody's like, no, I'm skinny. Like, well, then the poll ain't for you, okay? Anyway, all right. What do we got over here?
When you announced the deal, Jessica Reif Ehrlich in her note thinks it could be 200 million. Is that accurate?
Well, I think there's we had a range of 50 to 100 with regard to back office and costs. We're on our way to kind of doing that. We did that.
Yeah, okay, this is extremely boring. Sorry. I can't handle this. So let's go to something else. How about we talk about the home builders? Okay. Oh, wow. Interesting. Very interesting. All right, here we go. Now we've got to talk about the home builders because home builder stocks have taken a breather. In fact, shares of home builder indices like the S&P Home Builder Index, which includes companies like D.R. Horton and Lennar and the Pulte Group, they've kind of stalled a little bit. Now, it's not to say that they haven't done extremely well from the lows of mid last year, when we were actually thinking that there was still a real chance of going to a real housing crash, which who knows, maybe that's still ahead of us. But what you're finding is the home builders recently, at least based on the index, are starting to hit a little bit of a wall here. Some of these home builders are now starting to see a little bit of an onset of a correction, about a 10% drop. The entire group in total is down about 6.4% from its mid-July peak. Remember, a lot of stocks hit their peaks around July 19th. So maybe it's not necessarily terribly unsurprising that home builders have also hit a little bit of a peak, given that everything kind of bull ran in the summer here. But there's been some concern that maybe you're going to start having a little bit of stress at the home builders, given that rates are staying high for as long as they are staying high. There were a lot of people, by the way, HouseHack just wrote offers on 2 short sales. I'm like, this is ridiculous. Short sales again? And for me, I'm looking at it going like, okay, well, I mean, if I can buy a short sale, I'll buy a short sale all day long, because in a short sale, you might not know what that is, but I'll just give you a basic scoop. It's basically the homeowner is selling it, but they're selling it for less than they owe. So the bank takes a haircut on it. And the banks usually have a percentage that they're willing to kind of let it go for under market value by. And these are like the easiest wedge deals ever, because oftentimes the homes aren't even like a disaster, like destroyed hoarder homes or mold or roof leaks or whatever. They're just selling short. A person lost their job or whatever. And so I'm like, oh, this is fantastic. I'll buy short sales. So, because again, if you get a deal that's like 20, 30% below market value, who cares if the market falls another, 10, 20% or whatever, because you're insulated. The idea, and if the market goes up, well, then you've got a great property. If the market trades sideways, you got a great deal, right? So the whole point of wedge deals is insulating yourself from risk while sort of averaging into the market. But anyway, there's a lot of fear now that the home builders and their stocks have somewhat maybe capped out. And if I'll find that very interesting. Let's look at Lennar, for example. So we'll jump in over here and look at Lennar stock. You see that as well, capped out at about 133, dropping down to about 114. This has lumber costs are actually down for these companies. Lumber costs have fallen dramatically. That was one of the things that actually drove a lot of building price inflation, drove Home Depot stock, drove Lowe's stock. Lumber, LBS pricing has really come off some of its dramatic highs. It's taken a lot of pressure off of these companies. Lennar, by the way, reports earnings in 2 days, so we'll get a little bit of a look into the actual earnings for these companies. But here's the 1-month chart for LBS. You go out to about the 5-year chart. You can actually see we're almost at a low on the 5-year chart, with the low being seen over here in May of this year, very briefly, March of this year, very briefly, and January of this year, very recently, or very briefly. This chart actually only looks like it's letting me go out to about 1 year right now. So we're at essentially a 1-year low on lumber prices, which should help pump up some of these home builder profits, especially with this lack of supply of real estate. That's really what's holding prices up right now. We don't have true price discovery because the 30-year fixed rate mortgage is effectively canceling a housing-driven recession, which is also very bizarre, because on one hand, it's frustrating to a lot of individuals who are like, well, I really want there to be a housing-related recession so I can buy cheaper. But then on the flip side, there are individuals who are like, nah, it ain't going anywhere. So we'll see what happens. But I do think paying attention to the home builders and some of these home builder earnings will be very useful, and seeing some of them start capping out may start indicating some lack of enthusiasm for the home builders, which could be driven by actual fundamentals, that maybe things are starting to decay a little bit going into Q3, Q4. My favorite time to buy, something that I've been promising. I've been saying, look, at the real estate startup, we'll HouseHack, we'll start buying Q3, Q4, and we have right on schedule. And that's because this is usually where you see the people who have to sell are the ones you can get deals from. Because it's like, why are you selling once school has started? Well, because you have to. You don't want to move during that time. It's because somebody died, or there's a divorce, there's a short sale, whatever. Anyway, where there are problems like that, there can be opportunity. So my take on a little bit here on the home builders. All right. Okay. Let's see what else. All righty. So what we have here. All right. So here's an interesting piece on Elon. What is this? Walter Isaacson's new book, Elon Musk, hit shelves on Tuesday. Hey, that's today. And the author told CNBC's Squawk Box about a heated exchange he documented between Elon Musk and Bill Gates. Remember Bill Gates at one point famously being short Tesla. Isaacson said his book chronicles the good, bad, and ugly behind Musk, and that one of the things that upsets the billionaire is when people short Tesla stock to try to make a profit. There it is. Early last year, Musk met with Gates, co-founder of Microsoft, who had previously shorted the automaker's stock and bet that it would decrease in value. The demons and dancing in Elon Musk's head, including people who shorted a Tesla. Gates wanted to discuss philanthropy efforts around climate change with Musk, and Isaacson said that since Musk did not have an assistant at the time, the two had to text directly to set up the meeting. When Gates arrived, one of the first questions Musk asked was about whether Gates was still shorting Tesla, and Gates answered honestly, he was. Isaacson said Musk exploded, and he later received a text from Musk that called Gates insane, among other things. Well, that's kind of entertaining. Probably because if you think about it, it's so ironic that if you're a climate change activist, much like Bill Gates is, why are you shorting one of the greatest plays to benefit a cleaner environment in the future? Now, I know there's all the folks who are like, oh, but Kevin, don't you need to plug your electric car in? And guess what fuels that? It's still natural gas. True. But what about solar? And what about batteries? And what about moving towards more efficient energy usage like in electric vehicles? Electric vehicles on a miles per gallon basis are sitting somewhere around 70, 80, 90 miles per gallon. Whereas most of the gas guzzlers are still sitting between 25 to 40 miles per gallon. This is a massive increase in efficiency. So it is ironic that somebody like Elon Musk, yeah, look, the average MPG, according to Motor One, was 25.4 in 2021. It's ironic that somebody like, Bill Gates would want to short a company that basically 4x's the average miles per gallon. Think about it. Average miles per gallon for a gas vehicle, 25. Average miles per gallon for an electric vehicle, 75 to 100. So that's 3 to 4x more efficient. And so there is this massive irony. It would make a lot more sense if somebody like Bill Gates was shorting the oil companies, if he was truly trying to be consistent with the belief that, we want to motivate climate change. That's Bill Gates for you, I guess. All right. Next up. Let's see here. Hey, speaking of which, Tesla's up 1.3%. NASDAQ's rolling up. Yep, NASDAQ's trying to pull up. Look at that. Look at that. It's probably Tesla pulling them up. Intel up 2.6. Let's go. Look at this. Look at that Fibonacci bounce right there. I'm telling you, my sticks are on it. You can learn my TA in the stocks and psych course. 0 to mill, link down below. Coupon expiring Friday. Friday's the 15th. Yeah, not the 13th. Anyway, let's see what else here. Visa down about 1/3%. Ubiquity suffering still a bit. AMC up 6%, dropping a little bit there. Nvidia trying to go green. Bitcoin up 5.5%. Trade desks flat, basically. Sunrun's up 1.8%. Google down about 1/3%. All right, so some nominal bobbing around over here. Apple down 0.28 before the event. Apple's always down before the event and after the event. It's kind of wild. All right. So what else do we have here? Let's see. Let's find out. Oh, what is this? Retail workers quitting in droves. What could this be? Why are retail workers quitting? Retail workers need more money, not less. Why would you quit? Why would you quit in an environment where it is harder to get a new job? Let's find out. The job is more complicated than ever and increasingly not worth the low pay. Look, if people are quitting because they're getting a skill and they're able to provide value somewhere else and they're able to therefore make more money, hell yeah. I absolutely support that. Put robots in the job. But that's just my speculation. Let's go find out what this is all actually about. Money invested in your course is well worth it, says Milan. I'm up 65% this year. Let's go. Thanks, man. Look, you deserve credit for your allocations, but I appreciate y'all for the course shout outs. I really do try my best in providing value every day. So what do we have over here? Increasingly, some workers say the job isn't worth the wages. Low pay, erratic schedules, monotonous tasks have long been a challenge for nearly 8 million workers working in retail, but the pandemic years have added a host of new taxing duties. Employees must cope with an uptick in shoplifting and customer or whatever fussiness. Oh my God. I feel like I have the capacity to speak English, but boy, I'm not even going to try on that one. They manage online orders and run up and down aisles to unlock items as quotidian as toothpaste. Okay. Well, the sad thing is, employees really can't do anything in terms of theft. Somebody goes in and steals. You're just going to get fired if you do anything. 2022 McKinsey study found that the quit rate for retail workers is more than 70% higher than other U.S. industries. And the COVID years made the problems worse. Before 2020, the turnover for part-time employees who make up the bulk of in-store workforces hovered around 75%. Since then, it shot up to 95%. Holy crap, dude. How are you supposed to run a business with a 95% quit rate? Could you imagine that? If you have 100 employees at the end of, whatever time frame, let's say this is counted over 2 years. At the end of 2 years, you have 5 employees left. That's insane. You constantly have to sit there and hire new people. My God. They expect it so much. Speaking about his boss at Walgreens, where he worked as a customer service associate for years, Demetrius, who was 17 when he was hired, spent his days toiling as a cashier, janitor, shelf stalker, and passport photo taker. At times, it seemed he might have to provide security too. Oh, come on, man. Okay, that is not an excuse. That's bullshit. I would honor having multiple different roles at my job because guess what that means? You learn more. You learn more. You do more. You're capable of filling multiple roles, as any entrepreneur must, as any good employee must. That is why Trader Joe's trains everybody to do every different role at the company. It's not so you can complain about it, so you can be a more well-rounded person. One time, a visitor came in and demanded all electronic items behind the counter, keeping his hand in his pocket like he had a gun. Demetrius did as he was told. The guy grabbed the gear and walked out of the store without paying. I was like, wait, did I just get robbed? Yes, bro. Yes, you did. Okay. That part, I think, does suck. Like, I wouldn't want to work retail if I was getting robbed all the time. I'd be like, yeah, no, I'm done with this. I'm not risking getting shot for, minimum wage. What is this? It was the weight of these things that eventually drove him out of the minimum wage gig. I had to quit to take a break from working like a year just to get the ability to breathe and focus. Bro, that is bullshit. What the hell? Oh my God. I had such a hard job at Walgreens taking passport photos. I had to take a year off. You have got to be kidding me. This is the definition of embarrassing. How could you even say that in an interview? Yo, what up, bro? You awake? You need to take a year off because you're exhausted? What? Yeah, exactly. That's what I was thinking too. Anyway, the spokesperson for the Walgreens Boot Alliance says safety of our patients, customers, and team members is our priority. The company also offers mental health and well-being support. Okay. Retail apocalypse is the declining worker experience. Follows a tough decade for retailers. Yeah, no kidding. Oh, bro, Max is here too. Get over here. Get on camera. Yeah, you do. Get in here. Dude, you're never in here. People want to see you. Come say hi. Just one time. One time, come say hi. This cam. What? I'll give you $2. All right. Here's a $2 bill. Come here, bro. Did you brush your own hair? You did a good job. Here's $2. Bro.
I did your toothbrush.
Oh, you used my toothbrush?
Yeah. Mom thought it was so bad though.
Here, you get $2 too. I love you, bro. Thanks for coming out. Say hi, everyone.
Hi.
Want to say anything else? No. All right, you can leave, bro. All right. So, all right, what else? Customers and teams are priority. The company offers mental health, retail apocalypse, whatever. Stimulus checks, supply chain issues. Here's a 20-year-old cashier at the children's clothing in Bronx. Okay, well, they're in a tough area, but okay. There's some, by the way, real like badass people in the Bronx who are like, invest in the Bronx, man. Buy Bronx real estate. Respect. Anyway, New York, in New York, okay, finds herself frequently struggling to reason with parents unhappy with the price tag. Sometimes customers are understanding about this, sometimes not so much. She can't help but empathize as she rings up purchases and sees how much they're paying. I'm like, in my head, wow, this is crazy. Yes, that's called inflation. Guess what? You don't own assets. You get screwed by inflation. It sucks. And guess what? The government and the Fed ain't coming to help you either. Much of this isn't unique to U.S. retailers. All over have struggled to adapt to new shopping habits. Recent survey of managers in the UK find absences on the rise. Yeah, because they're going to go play World of Warcraft. U.S. workers tend to have fewer job protections and benefits. That's also true. To hear rank and file retail employees tell it, working conditions have started to deteriorate when they returned to normal after COVID lockdowns. Okay. Nearly 4 out of 5 companies have seen a rise in guest on associate violence. Yeah, I mean, I'd quit too, but I would go do something else. I wouldn't go take a year off. Political polarization, like the whole LGBTQ stuff at Target. That's true. Target was complaining in their earnings calls that their workers feel unsafe because people are coming in lashing out. And people's behavior has also turned to absolute crap. Crazy. Anyway, somebody now works at a smaller retailer where she's been provided with de-escalation training. Good Lord. I mean, this is actually very useful, right? Like, that is a skill set that will be very useful for you in a very, very long time in the future. Big fan of that. So, very excited about people learning de-escalation. That's useful for your spouse, and that's useful for your family, and it's useful for your job and your children. Just keep $2 bills around, folks. Anyway, so what? People can't get mad at you when you hand them a 2. Employees are now security and expected to de-escalate. All right, they kind of training has become widespread. Assistant in marketing found that less than 65% of lower level employees have received instructions compared to 82% of managers for de-escalation violence. Well, yeah. 23% frontline retail workers. Frontline retail. That's what they call it now. Frontline retail. 89% have negative feelings about stepping in when customers behave badly. Of course. I want to get stabbed or shanked. Duh. I don't know. This isn't too much of a surprise. Retail wages are rising slightly faster than those in other industries, but retail employees still get paid a lot less. True. Median wage for retail salespeople rose 55%, while other U.S. workers saw a 52% gain. Retail wages are up 21% since 19, compared to a 16% gain overall. But again, you're still at the lower end, right? Inflation has eaten away a lot of that. Yep, it's true. Yeah. All right. Here's a 28-year-old who says he works at thrift stores in the U.S. and says that I can't stress enough how much I actually do love the work. She says, I don't mind fixing racks all day long. I don't mind dusting a store. Well, there's a level of you not minding that, and then there's a level of getting complacent and getting stuck in that level and not wanting to graduate to manager or something else. It's cool to do this kind of stuff. I remember when I had my first house, I dug my own trenches for my French drain because I'm like, I'll be damned if I pay a plumber to dig my trench. Painted myself, drywalled myself, did my own crown molding, whatever. I didn't care. I wasn't going to pay somebody else to do it. Not that you necessarily need crown molding, but I was like, it's actually kind of cheap per stick if you do it yourself. It's surprisingly, crown molding is surprisingly cheap if you do it yourself. Surprisingly cheap. And you'll learn a lot about mitering. Anyway, point is, I don't know. Some of this complaining seems a little weenie here. Like, I get the idea of the security concerns, but boy, these turnover levels, it's not good, especially if companies end up being willing to just work their existing employees harder. Those employees end up getting paid more as a result, but then there's less staff to compete with. Now, what do you end up with? Well, you end up with a situation where you get more unemployment, and then you get people spending less money, and it's bad, especially in the lower levels. But that's kind of what we've been expecting anyways. Lower levels, we're probably going to be spending less income. So anyway, all right. In the meantime, let's see what's going on at the sticks, and everything's pretty much the same. Oh wow, Intel's now up 3%. All right, retail babies. Try working in the trucking industry if you can't handle turnover. I mean, that's true. That's a good point. That's actually a very good point. Trucking's hard. It's lonely too. Like, a mad respect to our truckers, man. Like, we need you. And the crap you get put through in states like California, oh my gosh. Anyway, I'm a corporate recruiter and businesses are being more picky with hires. Absolutely. Absolutely. That's my expectation. And that's the combination of this like quiet firing cycle that's going on. This quiet firing cycle is basically like businesses that are like, go ahead and leave. We don't really need you. You know, we'll just put more work on the people who are left. It saves us money. I hate to say it, but that's what's going on. Worked at Knott's when I was in high school. Worst job ever. Customer going off because of high prices. I'm just a damn cashier. See, but that builds character. That builds strength. People bitching at you. It's great. You know what? You got to get to the level. You want to know where the level you got to get to? When somebody's like spitting and screaming at you about all of this, to where, you know what you say to them? You go, thank you. You're absolutely right. And then shut up. Guess how much they're still going to scream at you after that? Guess how much somebody can yell at you when you literally look them in the face and you say, thank you. You're right. Try it. Try it sometime. I bet you the other person instantly shuts up. It's magical. It's like the opposite of what you would think you would need to do, right? Verbal judo, exactly. I worked at a gas station and quit just last week after 3 months. Too much BS and no leverage. I mean, like, the no leverage part is probably where I can agree with you most completely. Like, that's not a resume builder, right? Like, you're better off working for somebody for free or being underpaid for an internship, but actually having a resume builder. And speaking of which, if you can email us all the time, send us like a video resume or whatever at jobs@meetkevin.com if you want a job. We're always looking for good people. I don't need more people right now. I got plenty of people, but I'm just saying, like, I would rather do anything to intern anywhere at somewhere where at least I could, even if I could learn one thing, it would probably be more than the benefit I would get of having certain jobs on my resume. So yeah, I completely agree with that. I like some of these comments. Bronx, New York. Heck no, do not buy any real estate in New York. Anthony Rizzi does not like that idea. Somebody else told me that once to buy in the Bronx. Actually, quite a few people. Gary Gensler. I don't know. Do we actually care about this? I mean, okay, I'll go see what Gary Gensler is up to. But yeah, I don't know enough about real estate in that particular area to tell you anything about it. All right, so let's see if we can find Gary. Emotional resilience. That's right. Just smile. Yes. Yes. All right, let's listen to this for a moment.
Going to march in place.
I would say the risk to our forecast would be to the upside. And the upside potentially would be that rates fall a little bit. That would be one contributing factor of why you could get or argue or rationalize why the PE multiple would be a bit higher. Market trades at 19 times earnings. You got 7 stocks. They trade at 30 times earnings. The rest of the market, 493 stocks, trade at 17 times, which is sort of in line with the long last 10-year average. So the point is, could you get a higher valuation? Could you catch up, if you will? Some of the lower multiple stocks, could they creep up a little bit? That would support
But you need to see rates
a little
fall.
a little bit higher return.
But you need to see yields come down?
Rates would have to come down a little bit. Or if it's not valuation expansion, then it has to be earnings. Are earnings likely to be better than we're expecting? Probably not. We saw the trough in earnings this cycle in the second quarter results that came out about a month ago. Earnings are likely to be slightly positive as you go into the third quarter, fourth quarter. So things are getting better from a year-over-year comparison point of view. So it's either earnings or valuation that would have to take the market.
But you don't
higher.
see them. You continue to see the money kind of staying in or moving into money markets as much as it would go into the market. That's not part of your forecast at all. That it would sort of move into equities.
Correct. It's not a rebalancing. When we look at the major owners of equities, you've got households, mutual funds, pension funds, foreign investors. Those four categories, they comprise 90% of the ownership of the U.S. stock market. So we look at the relative movement across those different assets, how they're allocating their assets. David, they're at the 97% allocation to equities. So they're basically there. And, on the margin, does some go in equities? Sure. But on the margin, more likely to be in cash.
Finally, is the softness in buybacks a cautionary tale, or is it just because there's too much else to spend money on right now at corporates?
Well, there was a concern, remains for a number of people, the concern about the potential for economic softness. And so the concern about companies wanting to maintain stronger balance sheets is definitely one of the variables. What we find in a slowing economic environment, which would certainly characterize right now the environment, still growing but slowing at a slower pace, that would suggest that companies that are prioritizing stronger balance sheets tend to outperform, and that's sort of the environment. You are correct. The year-over-year growth in buybacks down almost 20% in the last quarter, so that's a concern. But a lot of IPO issuance also happening.
Yeah, that's true. This week will attest. David, good to see you. Talk soon.
Good to see you.
David
you.
Costin.
As we head to break, here's our roadmap for the rest of the hour. Speaking of, ARM gearing up for its IPO debut this week, but it is facing risks in China. What investors need to know.
Plus, we'll have more from my interview with Brookfield Asset Management's Bruce Flatt. We'll talk about where he sees opportunity.
And finally, one of the biggest antitrust trials in decades. What's at stake for Google in its battle with DOJ? We're still ahead with the big show when we're back in 2.
All right. San Diego is the hottest market right now that I've seen across the country. And look, I want you to know, when I tell you about real estate, it's not just data that we look at. It's actually physically going there. That's why I fly places everywhere. Flying probably more than anybody watching this video. Certainly this year. I think we're at, how many hours are we at now? I don't know, probably at like 300 hours or something like that already, which is pretty crazy. But anyway, the point is, San Diego is the hottest. Out of all of the markets, it is the most aggressive market that I've seen. Yeah, even out of even comparing to well, you have to Miami's pretty hot too. But you have to be really touchy in Miami, mostly because it's very difficult to buy in Miami, because the people who are buying in Miami are like trying to gentrify Miami, which is basically when you're trying to like tear down an old crapper and like build a McMansion or something like that. That's the kind of investing that people really despise. But yeah, you go close to downtown Miami, it's like a different world. Yeah, the nice thing about San Diego is, at least in my opinion, San Diego is not going anywhere anytime soon. The weather is so great. I personally prefer San Diego weather over Ventura weather. It's a little warmer, so you get less of a marine layer, and I like hot. All right, so what do we got over here? Ah, yes. All right. Let's touch on this. Well, tomorrow is CPI day, and these are the latest forecasts broken down by Nick T. We've obviously covered the complete consensus of forecasts, and we'll discuss those in more detail. But most importantly, we want to highlight Nick T, our Fed whisperer, Mr. Nicky Leaks. Wall Street forecasters expect August CPI to show headline rose 0.6 in July, boosting the 12-month rate to 3.6 from 3.2, thanks to energy prices. Remember, gas generating around 60% of that headline movement. They see core CPI up 0.2%, lowering the 12-month rate to 4.3 from 4.7 in July. And these are some of the breakdowns over here of that core level. Look at those core estimates. I mean, the highest one over here is 2.5, or well, 0.25. But a lot over here at 0.15, 0.18. This is where I lean over here in this lower area, 0.14. Pretty exciting. CPI is gonna be exciting. All right, what else we got over here? Let's listen.
System deglobalization, and the biggest one that is out there is the decarbonization of the world. And so we took our renewables business, we separated it from infrastructure. We created a fund. We raised a fund last year or 2 years ago with Mark Carney as the head of it, and it's for decarbonization. And what we're doing, it's a $15 billion fund, and we're out raising a second one now. And what we're essentially doing is providing money to companies or assisting them have less carbon within their system. That's all.
How are you doing that?
It's not good.
Right.
We're not making decisions as to whether things are good or bad or black or green. We're just providing money.
So it's not an ESG product.
No, well, look, it sort of is. But remember, we're not making any judgments. What we're trying to do is help companies have less carbon. So an example, many of the technology businesses in the world have committed to net zero very quickly. What they need is renewable power. So we are building them renewable power in many countries in the world. So we're one of the largest builders. We're one of the largest owners of renewable power, and we're building solar and wind in 15 countries in the world. And we're providing that to them. And before you used to sell power into the grid, today we're actually selling it to the corporate customers, and they're using it within their systems.
How are you structuring these deals? I mean, are they all different based on the needs of the borrower and or end user of the cash, or do they share something similar?
So I would say they're all bespoke transactions. And I guess the increasingly what these large institutions and why companies come to us is because we can provide a buyout, we can provide a partnership, we can lend money. And so we have all of those activities that we can provide on a scale basis. Not many people can provide 500 million, a billion, 2 billion, 5 billion, 10 billion. With Intel, we recently committed to half of a $32 billion facility in Arizona, you may recall.
I do. I want to discuss that a bit as well, because I'm not sure people realize how instrumental you were in their ability to, or at least their plan to build all these fabs.
Yeah, and look, it's just people need, so our goal is be a solutions provider on a global basis in the industries that we participate in. And if people need debt, we'll do it.
How did the passage of what is still called the Inflation Reduction Act impact, if at all, the way you think about allocating capital in this area?
You know, look, we own a lot of things, and we bought a lot of them prior to that, not because it was we knew it was coming, but we benefited from that a lot. What it essentially means is that if somebody had a bunch of projects and they expected 50% of them would get built out, because of the Inflation Reduction Act, 75% will get built out, which just means that we're going to compress more projects into less time, and that's good for business. Right. And it's going to get more renewables built out in America.
And what kind of returns are you typically targeting, particularly in the interest rate environment in which we live now?
Yeah, so look, our on the low end of debt products, which would be the lowest type of returns that we get, mezzanine debt products are in the circa 9-10% return. And our equity investments, which we target higher returns, are close to 20. You know, our real estate strategies have earned 20% compound.
Whatever. Let's go to this piece by MarketWatch, which is actually pretty incredible. Well, if you needed yet another reason to love Tesla, folks, here it is. Once again, a study put together by MarketWatch now suggesting that it is basically very likely that Tesla's insurance division, again, vertical integration here. It's not just making your own chips that make the AI and having the cars where people train your AI, where the people are basically the robots. It is now Tesla Insurance that is potential. And don't even get me started on Tesla Energy and batteries. You remember they bought out or they created their own in-house inverter for their solar panels so they could stop using SolarEdge's inverter. Whew. Tesla's a real competitor, even to companies like Enphase. Anyway, so what about Tesla Insurance and what is MarketWatch telling us? MarketWatch is actually telling us that insurance for Tesla, while everybody else is complaining about higher insurance rates, remember the Wall Street Journal talking about people dumping their homeowners insurance in Florida because insurance is getting so expensive. All this inflation in insurance for cars as well. Guess what's actually getting cheaper? Tesla insurance. Why? It's getting cheaper because the cost of the cars are going down. An ironic benefit of lower car prices is a lower insurance. And Tesla has this fanatical way of essentially trying to study every accident that occurs with the data that they collect, so that way they can make engineering changes and actually simplify the insurance process in the repair process. But here's some data from this piece here. Tesla Insurance can be up to 49% lower than its competitors, which kind of sounds like an ad. The only ad here, though, keep in mind, is the fact that coupons are expiring this Friday, and prices for these core courses are going up. But anyway, as we provide more value, of course, that's the goal, right? The goal is always prices go up as we provide more value for them. Lifetime access to those courses, by the way. Anyway, Tesla's success is actually expected to potentially cause more competition for other car insurers, your Geico or whatever else, potentially bringing down average insurance prices, actually helping contribute to disinflation. You're also potentially now able to opt in to getting even lower insurance rates based on your safety score. Boy, I hate the safety score, but whatever. Tesla, I barely drive, so it doesn't really matter. Tesla's entry into the insurance market is really obviously, waking up other insurance companies that, okay, we need some of these telemetrics where we actually give people discounts based on how well they drive. It's probably a good thing. Tesla Insurance right now only exists in 12 states. It's important to remember that. Like a lot of people are like, oh, yeah, okay, Tesla Insurance, whatever, a small part of the company. Partly, it's a small part of the company because they're only licensed and able to provide in 12 states. It was pretty dang low. So it's a big deal. You also have this concern over, is there potentially too much invasion or data privacy concerns or whatever? I personally find that most people who are like, I don't know, man, if I could save $20 a month on my insurance, I don't care. Take my car privacy. No guarantees, obviously. That's just my opinion, but I think you can clearly incentivize that away, right? Obviously, the insurance is a work in progress, but some people are basically using this as a way to say, like, don't forget, when you're looking at Tesla, and it's not like we need even more reasons to be bullish about Tesla, but you look at Tesla, it's like they really are trying to disrupt every single level of the business. And it's really impressive. And it's still just so shocking how low you have that institutional allocation for Tesla, because it really creates some excitement over what's to come for the future of the company. So we shall see. All right, let's see what else we got here. Let's jump in over here.
And as long as we can get the economics to work with our capital, then we're happy.
Let's talk a bit about the go private market, leverage buyout market, if you want. we all hear about all that dry powder. It's like it's been endless talking about it. What are your expectations, given the higher cost of capital for so many sponsors? Do they still go to work here, and are sellers adjusting to the new reality in terms of where they may actually be able to get a clearing price?
So just for context for your viewers, we put $50 billion to work, maybe more than that now, but over $50 billion to work in buyouts in the last 12 months. Very few people were able to do that, and we were able to do that because we have lots of dry powder.
A lot more coming behind that, of course, Sarah. They're talking about a $2 trillion asset under management target in the next 5 years as they present their case to investors. And again, I know you've spoken with Mr. Flatt a number of times as well, but sort of underappreciated perhaps the power of these platforms in terms of their ability to invest across such a wide variety
And
of
just how much
businesses
is in.
and raise so much money.
Yeah, I mean, this isn't like an office REIT. People think Brookfield and they think the malls and the property. It's such a big infrastructure and renewable business. They have done a lot of deals, both on the retail, they bought retailers and others. And actually their stock has done very well this year. I'm curious what the investor day, what some of the tough questions were around investor day there.
Yeah, it hasn't happened yet. So it's underway. And you're right. I'll be curious to see as well, because over time, this has performed extremely well. We have seen some of the stocks of the alternative asset managers not perform nearly as well as their investments that they do on behalf of their LPs. So worth sort of focusing a bit more on Brookfield. Of course, they do get the press, to your point, for when they're walking away from a number of these mortgages, which they've been doing, and giving the keys back to the lenders. Yes, in certain properties. But office space, represents a relatively small percentage.
All right, let's take a peek at something else here. Let's drum up some entertainment. How about that? Everybody loves entertainment, right? I don't know. People get mad at me when I talk about this kind of stuff, but I'm going to do it anyway because it's my live stream. You're going to talk about RuneScape. No, okay, we're not. Actually, what I'd like to do is catch you up on the latest on Donald Trump. That's what I'd like to do right now. So the latest on Donald Trump, obviously Donald Trump released a 9/11 video. He literally just minutes ago posted on Truth Social blasting Joe Biden for suggesting that he was at 9/11 the day after on 9/12/2001. Some people are calling Joe Biden's comment that he was there and remembered being there in the horrors a lie. Some people are saying he just had a little mental blemish. Either way, if it was just a mental blemish, it kind of questions again, okay, is he really fit to run? And then other people are like, oh no, he's just lying again. I don't know. There's all this sort of craziness going on. And ultimately, whether it was a lie or a fib or it was just forgetting, I don't know how you can forget, but anyway, it was forgetting. This is some of the latest drama that's going on and the latest that Trump's posted on Truth Social. But what I do think is very interesting is that Trump is now trying to get Judge Chutkan to recuse herself. And the reason for that is some of the judge's background. Now, some folks on the left are arguing that Donald Trump is just trying to delay the process because Donald Trump's trials are set for right before Super Tuesday. The way in which the timing of how this trial is supposed to be set up has occurred, has left a lot of Trump supporters frustrated, arguing that the judge is clearly biased against Trump, trying to sandbag him in the 2024 election when, some on the left say, hey, look, well, she's not the one who indicted him. It's, this is not her. Okay, don't blame her. And so then some people on the left are going as far as saying, hey, she's just a, black woman and that's it. She shouldn't have to end up getting recused just because Trump doesn't like a black woman. That's what some people on the left are arguing. Donald Trump is obviously making the argument that no, she, ended up working for Schiller Flexner LLP, and these folks are, deemed to be individuals who not only lean a little bit more left, but it's worth noting that when Hunter Biden was an attorney, he also worked for that same firm. So there's a lot of political bias that those on the right are saying is injected into this request to have this particular judge supervise the trial of Donald Trump because it might be a judge that might favor more Democratic leaning result, which that's why Donald Trump is trying to get her to recuse herself because he's alleging bias. Of course, at the same time, you've got Jack Smith now telling the judge that Donald Trump is disobeying his protective orders, and now they're trying to get the judge to basically gag order Donald Trump, which is another reason Donald Trump is trying to get the judge recused. Donald Trump could theoretically end up getting thrown in jail, much like Sam Bankman-Fried did, if he continues to violate protective or orders in terms of threatening witnesses or witness intimidation on social media, which, of course, those on the right say he's not doing. Those on the left say he's doing actively every day. Or honestly, it's like, how do you be a judge in this situation? But then again, where the judge used to work does kind of raise at least some eyebrows. What is very interesting is, and I purposefully wanted to look at this, and I know nobody trusts them as far as you can throw them. I had to send cease and desist letters to them when I ran in California for governor. CNN's latest poll, and we're going to look at Real Clear Politics and the average of all of these, but I thought it was very interesting that CNN, of all people, CNN, of all companies, CNN suggests that between DeSantis and Ramaswamy, Trump is the best option for beating Biden, which I think is really incredible. You guys going to school? Get over here. Come say goodbye. Mwah. Have fun at school, bro.
Bye, guys.
Max, get over here. Oh, what are you grabbing to say goodbye? You're grabbing the needler, bro? You taking the needler to school? You can't take weapons to school like this unless the Covenant are there.
Bam. Bam,
All right, I'll see you guys later. Have fun at school. Bye. So anyway, going back to these things, we look at the average of these polls here. Obviously, your leading contenders right now against Donald Trump, based on basically every single poll that's being conducted, is your top three for Republican are either Trump, DeSantis, or Ramaswamy. However, Ramaswamy, if you end up putting against Biden, Pence, Haley, Scott, or Christie, CNN thinks that they would win over Biden, which is kind of interesting because that's leading some on the right to say, of course, CNN wants you to think that. CNN wants you to put up a weaker candidate so that Biden does end up winning. Of course. But anyway, I did think it was very interesting that at least in these three, they suggested Trump was in the strongest position. I found against Biden. Found that very interesting. So anyway, this is just some of the latest drama, and I want to catch you up with a little bit more speed. Obviously, there's a lot going on here. Some people are alleging that the judge is biased not only because of her history working for this law firm or setting trial date for Donald Trump the day before Super Tuesday, but also that allegedly she donated a bunch of money to the Obamas. Honestly, if you ever want to do anything in politics, I feel like it's like you almost can't donate to anyone because people are just going to go through your history and go, well, you supported this person who screwed this up. It's like, oh gosh, like the transparency of donations. On one hand, it's probably a good thing, but then on the other hand, it's probably like, okay, it's kind of tough. But this gives you a little bit of the latest on the madness that's going on. And I'll tell you, this election cycle is going to be really, really entertaining. And I do want to also show this right here from Tucker Carlson, because I think Tucker made a really great argument. So let's listen to this from Tucker. Let's pop this up and we'll go ahead and listen right about now.
There's a reason in the order. It's not just that it's nice to say what you think and that it's essential to human dignity to be able to express what you really believe, though that is true. You cannot be a full citizen if you can't say what you think. You are instead a slave. If you're not allowed to say what you think, you are not a citizen, you are a slave. It's that simple.
This is also a very interesting thing to consider, is that at the same time as this, if you're not allowed to say what you think is going on, this is massive debate going on at Twitter with the ADL and Elon Musk now suing the Attorney General of California, suggesting, hey, look, we don't want to define what hate speech is because that's not our job as a platform. Like, if there's a law and somebody's violating it, we can enforce that. But just defining what hate speech is, which is protected by the First Amendment, is not something Twitter is going to get involved in. Now, X, obviously. And this is very similar to the echo you get here from Tucker Carlson. Continuing.
And you don't need physical shackles because you have them in your head already. So that is all true. But that's not why they're trying to control what you say. They're trying to control what you say because they know that if you say it, nothing will ever be the same. And this is exactly why they hate Trump. And it's not an endorsement of Trump, but it's just interesting since I've known, I've watched the whole Trump saga, and I've had various feelings at various times. I've been incredibly frustrated by Trump because honestly, who couldn't be? And then other times I've been totally inspired.
This is actually a really interesting line there from Tucker Carlson. What he's doing is he's papering over his text messages that came out during the Fox depositions, where Trump is basically like, I hate Trump. I can't wait for Trump basically to become irrelevant, right? He just papered over that by saying, look, I've been frustrated by Trump. I mean, honestly, who couldn't be? But in fairness, that's actually relatable. I think at some point, everyone has been frustrated by Trump. But then the fact of the matter is, even if you're on the left, everyone's been frustrated by Biden. Why? Because nobody's perfect. That's the way it works. Nobody's perfect. I think that's fascinating. Okay, let's keep going on.
And excited. But the whole time I'm watching Trump, I'm thinking to myself, the core question, which no one ever asks, which is, why do they hate him so much? But honestly, why do they hate Trump so much? It's the talking. It's the talking. It's not because Trump's program is so radical. Are you joking? If this were 1985, he'd be like a center-left liberal. It's not.
It's actually somewhat of an interesting point. I was thinking about that. So you have Vivek Ramaswamy, who is taking this approach of, I want to be known as extreme. He's literally going on interviews going, oh, I want to be called extreme. Because that's one way to make a name for yourself, right? You say something crazy and then you get media attention. And I'm not necessarily saying crazy is bad. Maybe that crazy could be good. I'm not trying to cast my opinion on it. But when you say something like, let's abolish the FBI and abolish the Department of Education, first of all, half of the country is going to be like, I don't know about that. And the other half is going to be like, hell yeah. And that's fine. But the point is, it is extreme, right? And so you've got Vivek, who says things that are relatively extreme to get attention. Donald Trump does not have to say anything extreme. He just has to kind of play the middle, which is kind of remarkable. Now, somebody here says that, well, the problem with Republicans is they want us to work until we're in diapers and die. I personally think that might be, and this is trying to come from as much of a in the middle point of view as possible. I personally think that if you're working at something that you're not happy about, you should try to do whatever you can to change that, right? Get an education and change something and work where you have at least some enthusiasm for what you're doing. Look, I don't like waking up at 4 a.m. every single day, and I don't need to. I can retire. But I choose to because I do also get excited about providing value and perspective and hopefully motivating people. There's someone else here who says, hey, Kevin, is the money course, he's talking about how to make more money and get SH9T done faster, course worth it for somebody who has a little money and is 22 years old. And I think one of the best places to get started on building your careers, making sure you get the perspective that it's okay to work. It's okay to provide value early on. Right? Yeah, we have a coupon code expiring this Friday, but email us if you have particular questions like this at staff@meetkevin.com. Let's keep going with Tucker Carlson here.
Radical at all? That's fascism? Are you joking? No, it has nothing to do with what he does. It has everything to do with the fact that for whatever reason, his brain is not entirely controlled by the people in charge. And
this getting a lot of cheers. Obviously, nobody wants to hear that you're being controlled by some mystery person. That is the biggest fear people have of politicians, is who's actually backing you? Who's actually making the decisions?
Because he's not entirely controlled. Well, first of all, it tells you that everybody else is entirely controlled. If Trump is the one they hate the most, what did Trump do wrong? I mean, you can say, oh, well, he's orange or whatever. Okay, fine. But has he really committed a crime so severe that we should send him to prison for the rest of his life? That's insane.
Obviously, this is, referencing J6. That's obviously where a lot of folks on the left are going to go, hell yeah, send him to prison for J6. People on the right, as you can hear the audience.
Insane. And half the Republicans in Washington, probably closer to about 95%, would be very psyched if he went to prison for the rest of his life. So why is that? I'll tell you exactly why. I know, because I've watched this really carefully from Washington, for his entire term, and then the subsequent 3 years. They hate Trump because they fear Trump. And they fear Trump not because of what he might do, but because what he might say. And at any moment, Trump might be autistic enough to tell the truth about what's actually happening. Whoa, wait, what's that? I was in DC when this started, and Trump had the greatest line I've ever heard. And no one even noticed it except me, because I spent my life in Washington, but he was having some debate, and somebody said something about NATO, which is the North Atlantic Treaty Organization, post-war, to prevent the Soviets from invading Western Europe. And Trump goes, what's the point of NATO? And I remember thinking, what a stupid question. What's the point of NATO? Everyone knows the point of NATO. Like, it's to prevent the Soviets from invading Germany. But I was thinking, but there are no more Soviets. That ended in 1991. So, like, what is the point of NATO? That's actually, then I was thinking to myself, because I had been living in DC, so I was like captured by the groupthink that does capture you if you live in a place long enough. I remember my wife, who grew up outside Detroit, being like, why would anyone buy a Japanese car? That's insane. You know, I mean, she just grew up here. To this day, she would never have a foreign car. Like, what? They can't really be better. You know, you're a product of the world you live in. So I'd never thought of, like, what's the point of NATO? And Trump said that. And I remember thinking, well, that's an entirely fair question. I'm sure there's a good answer. Anybody? No one could answer it. And instead, they attacked him like he was Hitler. And I remember thinking, like, why are you mad at him for asking what turns out to be a totally legitimate question? And maybe you've got a good answer. What is it? Shut up. Oh, shut up.
I mean, obviously, the point of NATO is this idea that, hey, we can have democratic countries that essentially agree not to war with each other, right? That's what you have. You have military alliance. And by having a military alliance, you have smoothed over, simpler trade, basically. I mean, look at the North American Free Trade Agreement, which has since been replaced by new agreements. But anyway, like you have free trade between Mexico and Canada. You have incentivized trade between America and Europe. A lot of this has to do, in my opinion, with the economy in terms of the existence of NATO. And there is, I mean, technically, there has not been a democratic country that has warred with another democratic country. And this is not saying left-leaning. I'm saying like democracy, like a republic, right? You don't get that. Like, you don't, like England and Germany aren't going to war anymore. You know, Germany's not invading America. So you can have policies that do, try to shape, incentives in different countries. And those could be like taxing, for example, European vehicles that are imported into America to incentivize the purchase of American vehicles. And that's fine. That's why BMWs are so expensive in America. Whereas when you go to Europe, every taxi and every cop car is a BMW or a Volkswagen. Well, it's because you don't have these extra tariffs on them. So the point, in my opinion, is economical. But then the question is, which is raised fairly, is, okay, well, do you need a military alliance to create an economic alliance? And that's where some might say maybe not.
Up. That's your answer, really? And it was that kind of thing. And it was the fear that he might say one of 1,000 things that you're not allowed to say, which is pretty much everything at this point. And by the way, I'll stop at this and take our Oscar questions. But if you want to know, this is, and I'm being completely sincere, what's true? The true things are the things that you can't say. I cannot remember the last time someone in public life.
All right, well, cuts off here. So, yeah, this gives us a little bit of a look of what you've got from Tucker Carlson's POV, some of the latest that you get from the big old Donnie T. Some things to keep in mind are you do end up having the next debate coming up. I want to say that's actually this month. It's going to be at the Ronald Reagan Library. That's actually here in Simi Valley. So let's take a look at that. Ronald Reagan Library presidential debate. I'll obviously be covering this September 27th. So mark your calendar for that. That's going to be very entertaining. And that'll be California time in the evening hours, I believe 6. So it's probably be closer to 5 or 6, which would probably be somewhere around 8 to 9. Oh, here it is, 6 p.m. actually. Wow, that gets a little late on the East Coast. But anyway, that's 9 p.m. then on the East Coast. Presidential debate, Ronald Reagan Library. Check-in opens at 4 p.m. Viewing of the main debate is at 6 p.m. Obviously, we'll be covering that. And then it's expected to last 3 hours. I think that's because it's 2 hours for the actual debate, and then they do sort of, interviews with the media or whatever afterwards. So then you flip around between Fox and CNN or whatever channels you want to watch to get some additional commentary, which I think is pretty interesting. So yeah, all right. See what else we got going on. What's this?
Outside of China. And if you still think that ARM would be a good investment, even if it lost the China business, then at least you could feel good about the decision.
But it seems very complicated, the ARM China ownership structure. So there's no direct management from ARM or from SoftBank in this part of the business.
Sorry, my audio. Oh,
rip.
Eunice, are you there?
Sorry. Yeah. Sorry, you cut out. So
No, just on the complexity around ARM China, who manages it, who owns it. And it seems like a pretty big risk and kind of tough to figure out.
Yeah, absolutely. I think the risk itself is there for ARM, because even if you kind of look at who is who the shareholders are, it's not particularly clear, and also the way it's run, not particularly clear. But then there on the outside, you do have these external factors, such as the fact that the demand for consumer electronics isn't necessarily growing. People have been talking about how the boom for the fabless company is over, and so there's just like all these other factors that the company faces, which makes it a lot harder to think about whether or not it's a good place to put your money.
Indeed, the macro picture there, obviously a topic of discussion all around the world, Eunice. Big week. Thank you, Eunice Yoon, joining us from China tonight. Coming up at 11, the CEO of Airbus amid a big rebound in demand and production is going to join us live from the Chamber of Commerce Aviation Summit in an interview you do not want to miss. Meanwhile, we're back in 2.
Let's see what's going on with El Stickies. Oh, look, Tesla went negative. How entertaining. The NASDAQ went from, up to down. Actually, I think it only got to negative 0.14 or something like that. So everything taking a little bit of a little poopsie doopsie. Let's see if there was any news. Let's find out. Oh dear, the 7 o'clock hour. This week is very likely the dollar turn. Ooh. Are they trying to call peak of the dollar? Interesting. I think they are. Let's try let's see. Bullish dollar ETF. Oh, wow. All right. So let's zoom out here on the week. All right. So this gives you a little bit of a look of the dollar's movement over the last 3-4 years. Still pretty up there. Okay, bonds, ISMs. Let's see, what else? Seems like nobody thinks CPI will be lower than forecast. Yeah, I mean, they're already pretty low. Which is not great in the sense that you could get a miss to the upside because of that. What else? All right, yeah, nothing particularly that came out there. Eco data tomorrow morning we'll do CPI, and then the next day on the 14th we got PPI and retail sales. Okay, let's see what else. Oops. Okay, so dollar gains before CPI. Oh, okay. Yeah, this could be pre-CPI weakness. That would make sense. Nope. The ARM IPO, I'm so curious to see how that goes, by the way. If you haven't seen it yet, I made a really big video on the ARM IPO, and I broke down everything, in my opinion, you need to know about the risks of the ARM IPO. Specifically, as Sarah was just talking about the management. Basically, ARM, like 25% of their revenue is coming from ARM China, but they have no oversight at all into that division. They just have to believe what they're saying. It's very, very bizarre arrangement. Anyway.
Our Eamon Javers is live in Washington with more. Morning, Eamon.
Hey there, Carl. That's right. We haven't seen a heavyweight antitrust battle like this since the U.S. Department of Justice took on Microsoft back in the late 1990s. Right now, the Department of Justice's legal team is delivering its opening statement. You can see their team arriving outside the court earlier this morning here in Washington, D.C. The DOJ is arguing that Google built its 90% search market share by violating the law, spending many billions of dollars a year to become the default search engine on a lot of devices and squashing Google's competition. Now, later today, we're going to hear from Google, its chief legal officer, Kent Walker. You see here arriving at the court by himself this morning. Lawyers for Google will argue instead that the company built its dominance simply by making a better product that customers and business partners chose on their own. And anyway, they're going to say the government is defining competition too narrowly. Google, the argument goes, doesn't just compete with smaller search engines like Bing and DuckDuckGo. It also competes against any company out there where people are searching for information on their platform. Think about Amazon search for products or Twitter, now X, search for news items you might be interested in. We do expect Google CEO Sundar Pichai to testify at some point, but we haven't seen the official witness list yet, so that is not official yet, but expected. We also expect Apple executives to be among the witnesses brought in here to explain their side of the business arrangement. Likely, though, not CEO Tim Cook involved in that. The trial overall not expected to be over until sometime in 2024. And remember, this is just the first phase to establish whether Google has liability under antitrust law. If the court finds that it does, then they go to this second phase to figure out what the remedy might be. And that's where you get into all these fixes that might change the way Google does business, Carl.
Eamon, I mean, so many different questions. Any sense in terms of the strength of the government's argument at this point? I don't know that there's a lot of precedent. We have to go a long way back, I guess, to find it.
Yeah, it's hard to really gauge at this early stage, right? The opening statements have really just begun, and they're going on in court right now as we speak. But look, what the government is going to allege here is that because of its market dominance, Google has not innovated. Google has not really improved the search product in years, they will say. And that's because with a 90% market share, you don't really need to innovate. And they postulate this sort of alternate history where if Google had faced competition for all these decades, maybe search would be much, much better than it is now. Maybe we're living in sort of a stunted growth universe as a result of that lack of competition. Google, by the way, says, of course, that's not true. We have all these new products. Take a look at our product where you can take pictures in the real world and Google things by images. They say they are innovating.
Yeah. Interesting, Eamon. Thank you. That argument in some ways also sort of is a part of the structure for Lena Khan's approach to antitrust at the FTC. The power of these platforms, the power that they've had to perhaps stifle innovation. But what, of course, has happened so far is they have not been able to convince judges, at least in certain high-profile cases, that that's the way to view the law. All right, Squawk on the Street will continue right after this.
All right. Putin calling the Trump charges political persecution. Yes. Kind of hitting the sensitive topic. It's interesting to see, though, Vladimir Putin jumping in with his own opinions. Like North Korea's, president traveling to Russia by train, bulletproof train. You can't stop us. We're going to drive our train to Russia. Takes like a day. It's kind of wild. Yeah. Anyway. All righty then. So McCarthy greenlighting impeachment plans for Biden. Let's see. Yeah, the problem with that is you need a 2/3 vote of the Senate. You're just not going to get that because obviously not a single Dem is going to go for it. So I think it's more like tit for tat. It also just feels like a waste of time. Once again, it just feels like, why can't Congress just focus on helping Americans? I don't know. Let the election deal with that. Anyway, it does look like things are softening a little bit in L market. Probably again because of CPI coming up tomorrow. So keep an eye. Look at that. Just go right back to the Fibby. Why don't you? Oh, well. So anyway, that's what I got for today. Thanks for being here. 2 hours and 24 minutes. See you tomorrow for CPI day. And email us if you've got questions on those bundles or courses or financial advice, whatever, shadowing. Email us at staff@meetkevin.com. We'll get you taken care of. Thanks. Bye.